Welcome to the Dividend Talk podcast, episode 170. How to spot a bad company with our red flags. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co host, European DGI. If you want to learn more about us, please visit EuropeanDGI.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. How are you, my friend?
I'm doing really well. It's Saturday evening here. I switched my date night from today to yesterday because yesterday I understood, and rumors have it, that down in England, down in Ireland, I must say, everyone is in deep shock because of the Diageo earnings. So tell me more about this and tell me uh, if this was really the reason why you went to the pub yesterday to support them and to prop up their profits. I want to know everything.
I mean, Ireland cannot have Guinness losing 11% of its market share in one day. It just cannot happen. So, yes, I went out. I had a work thing yesterday. We had some Guinness, we had some Diageo products, and hopefully we will boost their sales because I haven't looked. I know you might have looked at the release, but I believe that their forecast for next year is quite poor, not poor, but worse than what they've expected. So we need to rally together. We get all these Irish people around and really help boost our sales.
Yeah, that's a thing. We can get soon into it, but look, I really deeply appreciate it, and thank you also for all the Diageo shareholders that are listening to the podcast today. That you took the effort yesterday take your colleagues with you, because some you like, some you don't, and actually go to the pub and buy as much Guinness as you could. I mean, for me, that's. I mean, it shows your dedication to the investors community, and why I'm always so happy to have you on the podcast here.
I mean, we have to look after each other, don't we? It's what we do. You look after your community. So I'm doing my best. I'm only one person. We need more. We need more people like this.
Yeah, but we can create a movement. So if everyone that is listening today, and we know that you're quite loyal because we can see also from the statistics that most of you all really listen to this podcast all the way till the end. So when you're listening, and if you're not at work or if you're not driving, but if you're nicely at home and have nowhere to go, take a Diageo product, prop up the European sales to offset the weaker LATAM sales. Let's show those people in Latin America how you do this.
Let's cheers to that. But honestly, have you had a look at their earnings? Why did it actually drop so
Well,
much?
it's a bit tricky, you know, and this is what I don't like. So I went into the news release because what they did, they released news release yesterday morning, and then they say at Friday 8 a.m. we will hold a call for investors. There's no link, nothing. So probably this was a call held between management and institutional investors. Yeah, so I feel already quite pissed off because I don't have any access to it. There was no opportunity for me to dial in, nothing. Secondly, they say they will publish a transcript. No transcript available on the website. So this just totally pisses me off. As a retail investor, I have no access to the information other than a report that doesn't say a lot. Yeah, so what the report says effectively is that This is due to a material weaker performance outlook in Latin America and the Caribbean, which is nearly 11% of Diageo's net sales value in fiscal 23 and is now expected to decline organically net sales by more than 20% year on year in the first half of 24. So effectively, we are talking here about 2.2% sales decline overall. Yeah. I don't know how much impact that is on their margins and such. So I expect that to hear in a call. So for me, this is an example of lack of transparency. I mean, they do a profit warning, and you know when they do it? Just before their investor day on Wednesday.
Mm.
So this will be fun, of course. Everyone will be happy there after this rapid decline of sales. But what I want to know, what I want to ask myself is like, is now the time to invest in Diageo? Yeah. So it's now at £27 and change, I believe, and it hasn't been trading here for a very long time. So
Yeah.
naturally you would say like, maybe it's interesting. My initial numbers says that it's still not interesting enough for me, probably more in the £25 around that, but I still have to do some homework. But to do proper homework, I need to get access to the right material. So probably I can look at it again on Wednesday when we learn more on Investors Day. I'm not in a hurry. If it so happens that it is trading at 30 again by then, well, I will have the joy of missing out. But this is really what I always dislike about companies when they are not transparent, and it looks like it's only available to those big pension funds or something like that. Because putting a release note out at 8 and not having any link to a webcast or anything, for me, this is just a lack of transparency, and I hate it.
And then would you imagine it's these big investors, big hedge funds that are selling? Maybe they know something that because I don't see enough in the press release for retail investors to get spooked and lead this heavy decline.
Yeah, so I don't know. It's quite a hard punishment, right? 11, it was at a certain moment 14% down.
Yeah,
That's not nothing. Yeah, it's really a big reset, I would say. So, I don't want to go into complot theories. I just know that I don't like it. I don't feel equally treated, and this is not good.
yeah, yeah. It's strange because we only have access to the report they released in August, which is I'm on their investor relations now, and in that one they say they're expecting quite positive actual
Yeah, and that's why they did a
returns.
profit warning now, right? And
Yeah,
they need to do this.
yeah,
Yeah, if they don't give a profit warning, they will be in trouble as well. So
yeah. So it's quite interesting. Something drastically changed in the last 3 months. Then we need to be aware of what that is. But yeah, I'm with you. There must be something deeper behind it. If they say there's a link and there's a webcast, that needs to be released to everybody, not just a
yeah.
select few.
So what I understand it is that, and what I hear also like on social media is that generally speaking, their products are usually more on the high end, more the expensive prices. So if there is an economic recession going on or people are hit by inflation, they might go for cheaper products, right, for their competitors.
Yeah,
Maybe this is the case. Also not a good sign because it means that the company doesn't have a lot of brand stickiness during these times, and also shows that it has a certain cyclicality in it, which people actually haven't experienced over the last decade, which is
yeah,
also very interesting. But these are the kind of dynamics that we need to understand better. And yeah, I'm just not happy with it. But hey, look, if you thought that there was just Diageo having a large drop, what about Ahold? Not too long ago they were trading about €30, 31, 32. Now they are trading at 26.75. They were even trading below 26 for a while this week, because also they released their earnings. Yeah, and it was quite a poor report, I must say. Not that it's like fundamentally changing the business, but their US business was not doing so well in the last quarter, which affected also their operating margin, which is now 3.8%, and they were aiming for always for 4.5% or something like that, to almost 5%. And on a thin margin business, that hits them quickly. And why? Of course, inflation, because they quote higher operating costs and such. So the EPS decreased also with 17.1% in Q3, but their free cash flow, they are still expecting between 2.2 and 2.4 billion, which is actually a guidance upward from where it was before. So it is a bit of a mixed bag, I would say. We know that in the 2.2 billion, there is this 380 million or something like that from the Belgium tax benefit. That was the whole narrative around quarter 2 earnings, right, at the time, that they
Yeah.
were so happy, but it was just a tax windfall. Of course, decreasing margins is not good for such a company. It was simply said a poor report. The market punished it for because the market lives by quarter to quarter. Long term, hey, listen up. They announced again a 1 billion share buyback, and you can buy a hell of a lot more shares at 26 euro and 75 cents than at 31 euro. So, as a long term shareholder who believes that this is just a temporary thing and they will recover from this, I'm not too worried, and I'm actually seeing it as an opportunity. I haven't been buying yet this week because it's already my third or fourth position in my portfolio. Generally, it's on autopilot at the moment, and it needs to be really in deep value territory for me to own more and to buy more. And for me, that is in the 22, 23 range.
Yeah.
Then I would be definitely buying again, but I don't expect it to come there anytime soon. But that would mean for me deep value. Now it's probably, I always say below 28 is fair value. I could nibble in a little bit, but if you look at where the market now is, also with all the other alternatives, it's like already a very fat position in my portfolio.
Yeah. Yeah. I think another quarter like this, and you might see it heading towards 24, 23. So it might get closer to your territory, to be fair.
Yeah, but if there's a good quarter after the Christmas, which it
It'll
usually
go,
had,
it'll
yes,
go
yeah,
the other way.
unless of course the quarter had one day less than last year, then of course hell breaks loose again. But yeah,
Yeah. Nice one. So two earnings and two not so great earnings this week. After what we had a couple of weeks where there were some decent ones in there, but it's a weird market, isn't there? Like it's been so choppy up and down. It's just hard to
yeah,
grasp where we are in the cycle. Is there recession? Is there not?
yeah.
There's interest rates. There's inflation. There's all sorts of things affecting the market. But it's been an interesting, I think, quarter. This one. It's really one of the choppiest I've seen in as my
Yeah,
time
in a
as an
very long
investor.
while.
Yeah.
Yeah, and usually this volatility, let's say this choppiness, is usually a sign of changing conditions, right? You see this in nature in general. When things start changing, it usually has these kinds of patterns. But hey, that was also one of the reasons why 2 episodes ago we put a poll out and we asked a simple question: do you feel that you are a good investor? Very interesting. From the podcast listeners, 61% said no. So the other 39% said yes. I had the same poll on Twitter with more than 800 people responding, and 75% said no. And this is very interesting, but it also makes me quite proud because I'm in the camp of no. Yeah, although we are 171 podcasts down the road, written many, many articles, I can tell you when you have losers in your portfolio, it's so humbling that it's very, very hard to say that you're a good investor, because what means good? For me, good means that I don't make a lot of mistakes. But of course, I make mistakes. I will continue to make them. Am I a decent enough investor? Yes, definitely. That's what I think, because my wealth has been growing and compounding over the last 9 years, and my how is it, expected cost of financial independence are already covered by 56% in dividends. Yeah, so I only need 44% left, hopefully within the next 4 or 5 years. So I will get there. But if you ask me, do you feel a good investor? If I look at the mistakes that I made over the last 9 years and probably will continue to make over the last 5 years and beyond, it's hard to say this, right? It's really hard to say this.
Yeah.
Probably, am I good enough for my personal goals? Yes.
And that's the key. Are you good enough? I mean, you're not a professional. You're not looking after some fund or responsible for generating wealth for loads of other people. You're just there to look after yourself and your own interests. So the answer is, are you a good investor? if you reach your goals and you're financially free and you have your FU money where you can quit work right now if you wanted to, then you'll be good enough, in my opinion.
Yeah.
But as investors, do we have a lot to learn? 100%. But
Yeah.
that's life. That's life.
Good. So the next poll question, guys, if you're listening now, go to Spotify. And the question is, do you consider buying bonds right now? We're thinking about maybe doing one episode about bond investing. So the answer to this question will be really interesting for us. So go to Spotify and answer please on the poll. Do you consider buying bonds right now?
Yeah, nice one. We've had some nice dividend hikes this week, actually. Three that I can think of, but one of them is a massive 12% dividend increase by ADP, which makes them soon to be a dividend king, I believe.
Yeah, I think it's already 49 years of dividend growth, and I must say, in the dashboard that we have, right, the premium members have to for the dividend growth compass. I was actually looking at ADP the other day, and because the yield is not too bad, I mean 2.2%. Yeah, okay. So actually, if we put the 12%, because we didn't update that yet, it would be like 2.34% or something like that. But they have a 5-year dividend CAGR of 12.3%. So, this is the typical example of a not even a very low yield, like Visa always with 1.4 or 1.5%, or Apple of 0.6%. But this is a relatively decent yield from that point of view that has been growing 12% over the last 5-6 years. So the latest hike was also in line with that. So I really want to do some more due diligence on ADP, study it. I'm impressed that this company is so powerful in this, because in the end they're managing a database, let's call it like that. But content is king, as they sometimes say. So it's very, very intriguing to me, and it could be such a company that I would like to have in my portfolio one time if it hits, for instance, 2.6, 2.75%, because that's typically my minimum threshold. So yeah, really nice dividend hike, totally in line with the last 5 years, and that under these kinds of market circumstances is really chapeau, really chapeau.
Yeah. And then two more then of note. Becton Dickinson hikes their dividend by 4.4%. That's ticker symbol BDX. And Roper Technologies has another double-digit 10% hike, and that's ticker symbol ROP. Honestly, of the three, ADP would be the only one that I would be interested in. I told you I owned them a long time ago and sold them when I thought they were overvalued, and they've proved me wrong multiple times over. But yeah. Okay, so our main topic is about spotting a bad company and some of our red flags. I think it's really important. Particularly, we spoke about the choppiness in the market. It might be a changing tide, might be changing. Lots of things could be changing. So it's always good to have your homework done before anything. So tell me, red flags.
Yeah,
What are some of
maybe
the
I
things?
should also introduce from my side a little bit,
Yeah, I
because
do.
I brought up the topic today, right? I was looking into Medtronic yesterday, because the stock is trading at $69. It hasn't been trading there for many, many years. I believe the last 9 years or something like that. I initiated once a position around $71, $72. I wrote an article about it at that time as well. So this must have been like early 2020. And you take then into consideration when you do DCF, like, okay, how much percentage will it grow over the next few years and such. But this stock just went nowhere. Yeah, it went nowhere over the last 8-9 years. It did also a large acquisition at the time, 42 billion. This is really, really large for a company of that size. And it was in 2013, 2014. They bought Coviden. And at the time already, 1 or 2 years later, it was clear it didn't add any value. They overpaid for the price, no additional cash flow. Um, well, almost no additional cash flow, let's say, but it was simply not adding any bottom line value to the company, which is very interesting. So effectively, they acquired the asset and there was nothing there. They didn't have any synergies or anything. Earnings, free cash flow over the year went a bit up and then a bit down, but generally speaking, if you flatten it out, it was all the same as 9 years ago. So here you are with this company, and I'm really puzzled what to do with this because it isn't my buy zone, but my buy zone, my fair value price assumed growth. This company had no growth, so it really started me put the question in my head like, am I just looking here at a bad company? Because when you look at the products, right, what I appreciate so much about Medtronic when I study it, I really fell in love with the fact of the spirit of the founding father of the company, how he created the pacemaker, what a what a track record of innovation this company has. But let's say over the last 10 and more years, it has been dead money. There was a management change, lots of expectation, nothing happened. They tried to acquire themselves into growth, nothing happened. They're all the time trying to pivot with their portfolio. Nothing worked. Product innovation. So some new product has offset declining products, but that's about it. Yeah, there's no growth here. And I think in general the medtech space has been difficult. Also, Johnson & Johnson had a flat decade almost with their business, although last year they grew quite significantly. We see it with Philips as well. So it's not an easy industry to work in, I would say. And it sounds like this company is at such a level that is maybe already so huge that it's really, really hard to grow for them.
Yeah.
But that makes me then wonder, like, really, is Medtronic a bad company? Yeah.
Yeah, I think listening to you and what you're saying there, bad company is harsh
Hmm.
because everything has been flat. It hasn't been declining. There's no
Yeah.
initial red flags. Bad investment is a different story.
Yeah.
Has it been a bad investment? That's potentially more
Yeah.
correct than a bad company because we are dividend growth investors, and for the growth part, the company needs to grow. It has to
Yeah.
grow in some way in order for that cash flow, the earnings to go to sustain a growing dividend. And if they can't do that, if they stay flat for 10, 20 years, eventually it gets to the point where the dividend is not covered, is not safe, or they can't continue to grow that. So they either cut it or
But you
keep
see
it
that
flat.
already. You
Yeah,
see that already. So if I go to our beta dashboard as an example, you can see that the company has been growing dividends for 7% over the last 5 years, which is quite a lot, right? And it yields now 3.9%. But the forward dividend is now $2.76, while last year they paid $2.67. Yes, so that's like a 3% hike or something like that they had in the last time. But also, when you look at it from a dividend safety point of view, the EPS payout ratio is 101%. The free cash flow payout ratio is 83%. It had
exactly.
negative 5-year EPS growth, negative 5-year free cash flow growth. So the only thing that it really has is a strong balance sheet and a strong dividend track record.
Yeah,
Yeah. But
but you
that whole gets you only so far. Yeah,
ex-
because they are deteriorating now the balance sheet with this.
exactly, you can only grow. You can only grow for so long the dividend without everything else growing in tandem.
Yeah.
It's just not possible. So
Yeah.
eventually, what will happen? They'll either have to go and into more depth to cover the dividend, or they just stop paying it, or they cut it, or so on. But
I just think that this company will give us like 1 to 3% dividend hikes over the coming few years, because nothing tells me that they are now really finding their mojo back into growth.
yeah, I think a company like this is dangerous in our world because
Yes.
you look at the history, the dividend history,
Yeah.
and you go, okay, strong paying company, and straight away investors like, okay, it's the type of company what I want to invest in. It seems like they have a competitive advantage. It seems like their products should do well. So you can make a case they should be doing better in 10 years' time. But in actual fact, they're not. And it's
Yeah.
because I'm looking at Seek and Alpha here, and you have all these analysis, and there's nobody saying sell. 9 out of 10 of them are saying buy. It's too cheap to ignore. But honestly, I don't know if that's true because fundamentally, where's this growth going to come from? What are they going
Yeah.
to do different in the next 5 years than what they've done over the last 10 years?
Look, under the same circumstances, right? The company, because the growth was flat, right? So the company was trading, what was it? 130, 140, 160 not too long ago. Let
Yeah.
me check. So if I check here, it is probably
20 September 21, it was $130.
there you go. So yeah, if you look at it from that point of view, then okay, yeah, maybe it can get back there. So that would be almost a doubling in price. And if you then say it's if you take your cues from past price performance, they are right. Yeah, and if investors were willing to pay for the same earnings $120 and now for the same earnings is $70, then you may ask yourself what has changed, because not a lot has changed in the last year. There's been dead money for 10 years. This is
Yeah.
the awkward thing about price, right? But my fair value always said somewhere in the 70, it's a good time to buy, but it assumed growth. And that's my fundamental issue. So when we then go to red flags, I agree with you. I'm not calling it a bad company yet, but it's definitely on the list. It's trying to prioritize itself in the queue to get there if nothing changes.
Yeah.
But
Yeah.
look, generally, what are really red flags for me, and this is what we are maybe not seeing yet, but sharply declining sales, and even worse, if management is ignoring it. I've seen this with VF Corporation,
Yes.
so
Yes.
the ones of these jackets and everything, but also Tupperware, which I have a lot of experience with, and even you could argue Intel, yeah, because Intel, I think I underestimated that. I thought that the sales decline at the time was mostly because management was just sleeping a little bit, but I didn't understand deeply enough how technology intensive this industry is, and that Nvidia was just eating their lunch in AMD as well, and that it's really hard to recover from that, and that it takes almost 7 years to a decade to regain your position here with that. So for me, sharply declining sales, specifically if you see management shoveling it on the carpet and one-offs and da-di-da-di-da, those are typically red flags for me.
Yeah. Yeah. Intel is definitely an interesting one to look at, and it's a good case because, as you said, they're losing a lot of market share. And in this type of industry, in that type of industry, as you said, once you're a customer of one of those and it works well, you typically give them a chance through different cycles.
Yeah,
And Intel were a benefactor of that for a number of years, and there was no innovation from them, but people were still giving them a chance because they were the
yeah,
number one in that field. But Nvidia are now top dog in that. And if you're gaming, if you want performance, if you are into your PCs, they're probably the chip that you want in your PC at the moment. So it'll be an interesting one to see how that goes. The only thing I would say for Intel over the likes of EFC is that market is probably going to go up. So they
yeah.
might be dropping in market share, but there's still enough there for them to increase.
Yeah, and
Um,
they can buy their way out of it
e- e-
effectively with buying the machines from ASML.
exactly. So there is hope for them, but VFC was also a really good example there because they don't have that luxury. That's not a market that's going up, so it's not going to raise their ship with them. So they had to struggle, and you could see that sharp decline. They cut the dividend first. And I pray people sold at that point because they cut it again just recently as well. But yeah, I think a sharp decline in sales is always a very, very good sign that something is wrong. But the problem is when you see that, if you're invested in a company like that and there is a sharp decline in sales, the share price is going to take a hammer. So you're probably going to lose money anyway, depending on what price point you buy these companies at.
Yeah. And this leads me then also to the second part, because some companies have a flat sales or something like that, or they are diversified well enough that if one unit loses sales and the other one increases sales, it stays flat, right? But what you see then typically is that other businesses, for instance, a higher margin business versus a lower margin business. Now, so what you see then typically happening in the reports is lots of adjustments to the earnings. So they communicate very, very loudly the adjusted EPS here, or even adjusted EBITDA, which which is really comical. Um, but then if you look in the adjustments, it's usually just poor management decisions. For instance, you could argue that restructurings are management decisions, depreciation of past of assets that they acquired like just a few years ago. Yeah, so the amortization of goodwill and such. So all these kinds of things typically lead to adjustments, which are typically results of management decisions. So for me, a point in case here is really IBM. People know that listen to this podcast that I'm really not a fan of IBM. These are the suits, not the engineers, that are trying to do something in the cloud. And adjusted earnings is for me a red flag. I can have it once or twice. Or pharma stocks, I understand this as well, because pharma stocks, they need to put in the books all their potential molecules, while they know that only a few percent will ever see daylight in the form of a medicine. So they're continuously putting it in the books and then also amortizing it again, right? But generally speaking, if it's like happening a few years, even a few quarters after each other, but even worse, a few years, then it's really a red flag for me.
Yeah, yeah. Management have a really big role in a bad company. Unilever springs to mind, and we have Alan Yopi, for example. He done a lot of damage to that company. We haven't seen much growth from that. I think we spoke, was it the last show or the show
Yeah.
before? We have Heinz Schumacher coming in, and he's given us this roadmap to growth, which
Yeah.
again I just find fluffy at the moment with no real substance. And to me, these types of CEOs, you have to give Heinz Schumacher a chance. You need to give him a quarter or
Yeah.
two to see is he actually going to do
Or
something.
even more than a quarter, right? If you're
Yeah.
a long-term
Oh,
investor, probably 2 years.
of course. But
Yeah.
like Alan Yopi really did a lot of damage to that company. There was zero
Yeah.
growth. He was panicking in the end, trying to make bad decisions. But another year or two under his leadership, and you could have been looking at a company that would
We would have had a dividend cut or something like that.
100%,
The fact
100%.
that he wanted to buy the consumer business from GSK, yeah, for what was it, 40 or 60 billion at the time?
Yeah, way above.
It was a heavy valuation for what it was. GSK even was almost laughing about it, but they still wanted to spin it off.
Yeah.
Which is also like crazy. They should have bought it, and they should have like put a priority UPS to Unilever and deliver it them in person almost. Yeah.
Yeah.
Saying like, you idiots. But yeah, for me it was same, and we saw the same with Bob Swan at the time, right, with
Yeah.
Intel.
Yeah.
It was similar. Sometimes it's obvious that you're dealing with a CEO that just doesn't know what they're doing.
Yeah, but I think we're speaking a lot of red flags here in terms of numbers, and we're looking at
Yeah.
balance sheets, financial statements. But sometimes, if you just take a step back, watch and listen to the CEO, and really listen to not just on the earnings calls, but what are they saying outside of that? What is the mannerisms? Are they panicking? What are they actually saying, and what are they actually doing? And sometimes you can get a feeling, okay, these guys or girls don't really know what they're doing. They're panicking a little bit. They're just saying stuff to make investors happy, but I'm not seeing real action. And sometimes you can get a really early sign before the numbers start declaring that look, management.
I burned my hand here with Jeff Immelt at the time as well from General Electric, but then I wasn't so well aware yet of the adjusted earnings and everything. I really had to learn that through the pain. But he was always like on the shows, and he was really how you say it, a charmeur. I don't know what is in English, but really like a smooth talker. Yeah, and yeah, but that's also become a red flag for me. Smooth talkers. Ricky Going said it as well. Those are the people with charisma and just almost able to talk themselves. They could sell their mother, if they wanted to a stranger within 5 minutes. Yeah. So, and that's where they probably should have worked in the sales department, but not being the CEO.
Exactly, but like everything they say is just, for me, it's fluff with no substance, and that's you can smooth talk all you want, but I want to see action. If you say something,
I want to see it back in the numbers. Show it to me. Tell me what we need to look for as investors, so we can judge whether that is indeed what we also want to look at.
Yeah.
And then deliver on it, and we'll evaluate it.
Exactly. I think IBM. Look, we know we spoke about these a lot, but I also remember that I think you challenged people to look at 10 annual reports and see what they were talking about. And it's like they changed every single year and they ignored what they said last year. So it's like, what's in this year? And then they didn't even mention it the next year,
Yeah.
and they had
And
something
then
else. So,
blockchain, and
yeah, it's
then
just
something else again.
it was just fluff and buzzwords. They always probably turn in there 100 times just to
Yeah.
appease investors to say, okay, they're working on the next big thing, but actually what they said last year they were working on, they haven't delivered on, and now they've changed again.
Yeah.
So I think IBM is a great case in looking at management, looking at what they say versus what they do, and
Yeah.
just to get a sense of what you should look for in good and bad management.
The day that this priest from IBM drops his suit and starts wearing a hoodie is when the share price will go up.
Yeah, we'll see when that happens. But look, as much as we beat an IBM, they're still continuing their dividend streaks. We have to give them some sort of kudos. Their financial engineering.
Sure. The balance sheet is
Uh,
really pristine, of course.
yeah, they'll be AAA rated before we know it.
Yes, of course they will. They will have probably bought someone from the credit rating agency or something like that. Gave them an IBM cloud in return. Shite.
Um, so let's move back on to some of the other things. And I think something we will both agree on is the balance sheet. Because the
Yeah.
balance sheet is probably, in my opinion, one of the most important financial statements you need to understand. And you can quite quickly see, because it's a snapshot in time, but you can
Yeah.
quite quickly see when the balance sheet is starting to deteriorate. For example, borrowing to pay dividends. We wrote about Nestle in our newsletters, and we can see the dividends increasing, but at what cost?
Yeah.
You can see, like, you could nearly see the dividend increases and the debt actually in tandem going up together.
Exactly.
So it's quite clear and obvious what they are doing. For me, that's one of the biggest red flags you can have. If you have to borrow consistently, I don't mind a quarter, and then
Yeah.
they make that back. But if you have to borrow consistently year after year after year
Yeah.
to pay them dividends, it's not a good sign, because eventually you have to pay that money back.
Yes, exactly, and that's why it's sometimes so hard with buybacks, because buybacks also, I said, make your equity go lower, because effectively what you're doing is you have the retained earnings, and then you have your stock treasuries, and that goes into minus. So from a bookkeeping point of view, you don't even get a really clear view on the balance sheet. But another thing that I'm always looking at is goodwill. Yeah, because sometimes you have more goodwill on the balance sheet, let's say 70 or 80% of this of the company, but then also fully supported by debt. So it's good, because goodwill is typically a result of, I said, of acquisitions. Yeah, you overpaid for the assets because you
Yeah.
believe you can get more value out of it. But if you then have a balance sheet which is 70 or 80% covered by goodwill, the risk here that you introduce is that they need to do write-offs on the goodwill, because what the accountants need to do every year is an assessment whether the assets on the balance sheet are still worth the same as they were a year ago. Yeah, and sometimes the test shows that it isn't. Yeah, because for instance, they started generating less cash flow. And if that happens, they need to do write-offs. But the issue is, if you're doing write-offs and you have no equity behind it, yeah, then suddenly the only one that has a claim on your balance sheet is the bank. Yeah, and you're in a very poor position then as a company. And so if you look at that point of view, also, like, this is where an acquisition can ruin a balance sheet overnight, and we have seen this also enough in the past. So yeah, it's really tricky. And balance sheets, yeah, it's like what they say, right? I think I mentioned that here one time on the show about banks. Like, on the left nothing was right, and on the right nothing was left, right, as part of the great financial crisis.
Yeah, yeah. It's it's definitely one of the most important things to look at, and something that's overlooked sometimes is legal challenges and how that can affect the balance sheet and the cash flow, because you might not see that right now. But we know with the likes of NN Group, which you wrote about, we know
Yeah,
Johnson Johnson, 3M, you have a rough idea how much that might cost them,
yeah,
and that will impact both their cash flow and their balance sheet over time. And I think it's really important to keep an eye on that. Can can they sustain? Can they weather that impact? Some companies can, but depending on the
Yeah.
size of the litigation, it can certainly dampen you. So I think it's important to keep a close eye on that as well, because it seems lately every company is facing some sort of legal challenge.
Yeah, it's the times we live in. The
Yeah,
times we live in. Yeah, so legal challenge we've seen with those companies, but one metric actually that I also look at, and if this is sustainably low, that's not good, and that is return on invested capital or return on capital employed. In the end, if a company invests $100, you want to get $110 out of it, and not $101 or $102, because inflation will eat it up. So a proper return on investment when they're investing in their own business is equally important. I have a slight favor of return on capital employed because it's easier to calculate for us based on the balance sheet. Because with return on invested capital, you really need to look at the business and also do some adjustments when needed. For instance, Apple is a good example. They have a lot of longer term investment, which are just securities, let's say. But for me, sustained low, I know also what the research shows, that sustained low return on capital employed really leads to underperforming businesses. You need to just generate cash to be able to grow in share price, to grow your dividends.
yeah.
Otherwise, you're just borrowing in the end.
We're back to we're back to growth and debt again.
Yeah, exactly.
It's just like a circle, is it? They all kind of
Yeah, yeah,
intertwine.
yeah.
So you're looking at
But this
growth.
is not much different than at home, right?
No,
If your salary is not growing, you're in trouble.
yeah,
Yeah, if you want to increase the your life joy, let's say. Yeah.
yeah,
So if you're like, let's say, what sometimes the career is, right, until you're like mid 40s, early 50, you're at peak earnings. Yeah. And then typically many people go a little bit down afterwards, or they flatten out. But then inflation comes around, which effectively you have a lot less purchasing power. So depending on how your home balance sheets look like, that you pay off your debt of your house, all these kinds of things, it's exactly the same when you're looking at companies.
yeah, yeah. And essentially you're the management. So if you mismanage and you're purchasing cars at 40% above market value and all these types of things, then eventually you're going to run out of money, no matter
Yeah,
if you're
funded on your credit card.
exactly, even if your
Yeah,
wages are increasing. So yeah, think of investments like how you'd run your home. It's probably the exact same thing. But look, lots of red flags there, lots of interesting things. I'd love to hear from other people as well. Is there anything that we haven't said or haven't looked at? Is there any red flags out there that maybe we should be looking at? Maybe there's an earlier indicator that we could find where I might not have bought someone like Walgreens, for example.
yeah,
Um,
good point.
so it'll be interesting to hear. But yeah, I think this was a nice easy topic to help with my hangover.
Good. So in that case, let's go to some of our well-beloved listeners. And I've got a question for you, which I find very, very interesting. And it
Go
comes
for it.
from Fabian, Schillacht Fabian.
Yeah.
And he's asking, like, do you ever look at, for instance, employee satisfaction? And the example that he gives is, for instance, Glassdoor. Have you ever looked at Glassdoor and, for instance, the reputation of the company and its culture and its management? Because there seems to be a strong correlation between culture and stock performance. So I know that Glassdoor did a research, and I think the top-rated companies have also outperformed the stock market. So have you ever looked at such things?
No, and that's interesting, and I wouldn't have thought about that. Now I know culture is important, but I feel like people leaving comments on Glassdoor. What I would have felt before what you said is that if you have a gripe with your manager, who's not necessarily top management, and it's just a personality thing, you would leave a bad review. And that's just life. And I know this because I looked up my company and I'm looking at different things. I know how it's managed, and some of the things I see are not entirely true in terms of how the culture is and how management is. It's just different people clash with different people. But it's no surprise to me in terms of culture that the best companies are outperforming, because that's where the best people want to work.
Yeah.
You want to work for companies where you're able to express yourself, you're able to grow, learn, you're able to do all them things. They'll get the best out of you, which means the
Yeah.
company will tend to grow. But that's quite an interesting study, I
So
think.
I've been looking at that, maybe not so much lately, because I know the companies that I'm invested in better. But if I don't know a CEO and I want to learn more about them, there are three sources: YouTube, looking at interviews, and I'm not talking
Yes.
here about the shareholder interviews,
Yeah.
but
Yeah.
they're often being interviewed on CNBC, or they're interviewed at a university or something like that. I find those very insightful. LinkedIn, just go to the LinkedIn profile and check what kind of experience they have, but how they are they like a homegrown manager, or how did they develop through their career. And the third one is actually Glassdoor, because it really tells you the approval rating, let's say, of former employees about the or current employees about the CEO, and I found that very insightful
Mm.
always.
Yeah. No, it's an interesting one. Sometimes I struggle to see it directly correlating to the CEO. As I said, people
Yeah.
have their own agendas, but
Okay, so but look at this new Unilever CEO.
yeah,
So as an exercise, Derek, look him up on LinkedIn. Check some videos from him, probably from Friesland Campina, where he was working before, and check what they're saying about him on Glassdoor right now.
yeah. You've done this, I
No,
imagine.
I haven't done it, but
No.
I'm asking you to do it, and then you can tell me, so I don't need to do it.
Okay, then. Nice one. Okay, I will. I'll make this. I'll make this promise. I will do that, and we will discuss it on the show, or we'll write about it on the newsletter. One or the other. Barrett has asked us a question: do you often set orders at lower or fair price and wait for it to be fulfilled? It could take weeks or months. I know you do
Yes, I
this.
do this sometimes. Yeah, yeah, yeah. Yeah. Not all the time, but for instance, if I have enough of a stock, or when I really want a stock but it's too expensive, I just put how is it, a good to cancel order,
Yeah,
and yeah, then at a certain moment they get triggered or not. I do make sure that every month I spend my money.
yeah, yeah. It was far easier to do that in 2021 when I think prices were inflated a little bit too much after COVID. We had this
Hmm.
big
Yeah,
big rise, so I wasn't in a rush to overpay for companies. In this moment, there are so many companies on
yeah.
sale.
Now I don't have anything outstanding. It's a
It
candy store.
because once I go on, there's always a company that I can buy. So yeah,
Yeah,
I think
true.
it depends on the market. If I want to or need to do that at the moment, I don't feel the need to just let my money sitting there waiting for a price to happen. There's plenty of other stuff out there. So
Yeah.
Tim Ainley has asked us: have you ever considered asking your own company's executive leadership team some tough financial questions as an employee?
Yeah, I did it once, but it didn't get answered. You know, you've got those poll questions that you can do, and it was not at the top, not voted the highest. I
Uh,
guess not everyone thinks like an investor in the company.
yeah, but I mean, those questions are picked, aren't they? So you have somebody reading all the questions. They're only going to give soft, easy ones that
No,
will
no, 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 no. In
wo-
our company, not.
no
They take the most voted.
most voted, and who
They
votes?
don't shy away. Employees,
Employees. Okay.
they don't shy away.
Pero has asked. Has he asked the question? No, he hasn't. He answered Tim's question. He basically said the same as you. He said I did, but only as an employee at an internal time hall. The questions were online and queued and selected for the best softball questions. His wasn't selected, so yeah.
Okay.
Val has asked us on the topic of Diageo consumption. The other day, he was trying to assess if he had a bias towards B to C companies in his dividend portfolio. Question is, what is the number or percentage of companies from your portfolio where you're also the customer?
Where I'm also the customer. That's an interesting question, right? But let's talk about what is it? Consumer staples, right? So I've got at the moment 14.2% in how is it? That's from dividend point of view. Sorry, I've got 16% in consumer staples, which is interesting because it was 25% not too long ago. Um, but that's because I have been building up a lot of insurance stocks, let's say this year, and real estate investment trusts. So you see that also the dynamics change. While I haven't sold consumer staples, the fact that I've been adding more to other sectors made it go down. Ideally, my consumer staples are around 20%. So I've got some space in the next time when the sector is down to buy some stuff again.
Yeah. I mean, I would imagine if you're an American, it's probably going to be a higher percentage of your portfolio because most people invest in American companies.
Yeah.
We invest in both European and American, so we were probably more of a customer in terms of European. Now, obviously, we buy the likes of
Yeah.
Coca-Cola, but I'm thinking the likes of Unilever, whose products are probably in everybody's household. So they'll definitely be top of the list.
Yeah.
But looking through my portfolio, where I'm actually the customer, probably very little.
Yeah, so I'm not a customer of my own real estate investment trusts. I'm
No.
not a customer of the energy companies that I have in the form of. Oh no, sorry. Let's say that I don't buy utilities here. Yeah.
Yeah.
So I am a customer of Shell, but actually not too often. Only when I'm traveling abroad, because near in my village there is no Shell. There's an Orlen. By
Yeah.
the way, Orlen is also a very popular dividend stock at the moment in the community, in the Polish community, because it has some commitment to dividends and a very high yield. So no, and also I don't live in the Netherlands anymore, so I'm not buying stuff at Albert Heijn, Unilever. I don't want to pay for the Axe effect anymore. I mean, I was using Axe, right, as a deodorant, and this doubled in price since the inflation. Talking about hyperinflation,
Yeah.
that one. So I switched to another brand, also a good brand. I think my wife still likes me.
Good question, though. It's a good question, but I think as European
And you don't
investors,
smoke, right? But
no, I don't.
You have British tobacco.
Don't smoke. Obviously, insurance companies in there. So yeah, I mean, and I can't even Ahold Delhaize because I don't have access to them in Ireland. So it's quite limiting. Probably Microsoft, Unilever, Coca-Cola are probably the three I can think of. Apple, no. I'm Android. I'm Android.
Yeah. I own Apple, but I don't feel like paying for Apple.
So the only Apple device I have an iPad that's maybe 10 years old, but I won it. I never bought it. I won it in a competition. So nice question though. Adrian has asked us. I love this. It's a little like lazy people, not lazy people, but the easiest way to get something. What is the most simple way to obtain a dividend safety 5-year history? Probably something Seeking Alpha, Kaifin. Probably the easiest. I mean, there's tons of websites out there. It's a lot harder for European companies, though. I don't know where you could find a European company that easy.
Well,
I think
in our dashboard that we're the beta version at least
that we're creating, but that takes quite some work. I mean, we can get it for American companies quite simply, but not for.
But we will have it.
We will
have it already for some companies, so that's what we're building right now.
We like the dividends. Question for you both. Imagine a company that you want to become a top 3 position in your portfolio, but it always trades above your fair value. Would you accept the dollar cost average above your fair value or stick to your fair value and never buy?
I wouldn't mind if it's within 20% of my fair value, because I may be wrong if it's a high quality company, but if it's above that, it's not worth it for me. Just the math doesn't work out.
Yeah, we get this question quite a bit actually, and I mean,
because what we see is that the prices stay very long time very high, and people just want desperately the stock in their portfolio. So, and if you're struggling with the patience, they think like, okay, but soon I will be waiting for a decade. The company stays underlying growing. So there is something to it, right? I fully understand this, but then you could argue like, okay, you could maybe overpay 20% for a company because then in 10 years you will still have a decent return. Yeah. But we know enough companies that were at the beginning of 2000 where it took almost 15 to 20 years to get back to the share price again after shit hit the fan. Yeah. So I really do think that valuation matters. but you should think in ranges or a normal distribution. Yeah.
Yeah, yeah, and m- maybe you don't have to be in a rush to make it a top three position right now. That's thing you spoke about return and event. Essentially, that's what you're after: some sort of return, whether it's
Yeah.
capital appreciation, whether it's dividend, whatever it is, you're after a return. You want the return on your investment. So there's never any rush to do that. Um, I think you hit the nail on the head in terms of valuation. You make a lot of assumptions in that, and it's just how confident are you in your assumptions, and if you think you're on the low end or the high end. But I have no problem in dollar cost averaging into some companies like that, but I wouldn't make it a habit, to be honest.
Would you like, for instance, dollar cost average in Nvidia if it would pay a 0.5% yield,
No,
or an Apple now?
no, no.
No.
Um,
Microsoft?
more like Microsoft or Texas Instruments at the time, even though Texas Instruments
Yeah.
are dropping. Those types of companies definitely would interest me.
Yeah.
L'Oreal possibly, but they're still way too overvalued for
Yeah.
my liking. But those types. Jean Christopher. Hello guys. Have you ever looked at Prudential Financial, ticker symbol PRU?
Well, I heard of this stock before and never really analyzed it or looked into it, so I just run it quickly to the screamer. But Jean-Christophe, and maybe also for the other listeners, so this is a financial services company that provides, for instance, insurance, investment management, and other financial products, right? It operates not just in the US, also a bit in Asia, Europe, and Latin America. And effectively, probably outside of Europe, it's one of the largest and well-known insurance and financial service company in the world. Look, first of all, what I always do, I look at the dividend history. They had to cut it during the great financial crisis in 2008. That's a bummer, but okay, hopefully they learned from it. They currently have a 5.4 dividend yield, which is really good.
Mm-hmm.
A 43% payout ratio, a 7.5% 5-year annual growth rate of the dividend. So for me, it ticks all the boxes at the moment. Yeah. So from the screener point of view, so it's probably a company for on the list and to once have a deeper look at.
Okay, nice. Xavier has asked us our thoughts on Airbus last earnings call and rumors around Enegas's dividend safety.
Yeah, so also here I looked at Airbus, the dividend chart. I see that they had no dividend payment in 2009, none in 2019, and none in 2020. The 21 dividend was lower than the 2018. So Javier, that's where I just stop. And even I'm biased by airline companies like Boeing and Airbus. We've seen Boeing also during COVID. For me, it's not a sustainable business. Very sensitive to the economic cycle, very sensitive to geopolitics, and very sensitive to government funding.
Yeah,
not a business that I like to be in. And regarding the Enegas rumors around the dividend safety, I haven't heard anything. So Javier, please ping me if you have any link to any information. I checked their investor relations website. I checked the last Q3 report quickly. I can't find anything. We do know that they had a certain commitment to upcoming years with dividends. It might be that this period is somewhere ending right now. Maybe they are reconsidering things. I don't know. But if you have any information, please share it with me. I will also then share it with the audience, or just put it on Facebook or on Twitter and tag me there, and then I can also do a repost.
Yeah, I tried to find something as well. I think they have a floor till 2025, if I'm not mistaken. So we have
That's
2
also
years.
my understanding. Yeah.
So I'd be surprised if they go back on that now, but we don't know. So yeah, I would definitely love to hear from you, Javier, just to see what those rumors are, and is there any truth to them? Maybe the Spanish community might know as well. David has asked us to look into MPC container ships and 2020 bulkers for this week's episode. Honestly, I would recommend checking out Jay Mincemeyer on Twitter. I think he's brilliant. To be honest with you, he does lots of interviews. He gives lots of updates. He gives honest opinions on them, and he would be far more knowledgeable. He spends like this is his area. So I would definitely check him out. I would never do these types of companies justice. I did own ZIM for a brief period, but it doesn't make me an expert in this field. So check him out. Jay Mintzmeyer is his name. I think he's definitely want to follow on these types of companies. Div Collector has asked us, would love your view on cyclical 34 years or so dividend growth, Whirlpool, ticker symbol WHR.
I guess most people know what Whirlpool is about. If you don't, they produce these very, well, washing machines, let's say.
Yeah.
I want to say very, very good, but honestly, I remember my father-in-law when we bought a Whirlpool dishwasher. He has been cursing to me for 2 years when we had to live together. So, and I understand now why it was shite. So, but anyway, yeah, of course, it's a cyclical company because when there's an economic downturn, home appliances that cost like €1,000 or something like that are just too much. Also, they sell more when people are going to live somewhere, right? When people go out of house from their parents and start to live somewhere. So, but hey, listen up. Their dividend yield at the moment 6.4%, which is really a lot, but a payout ratio of 43%, a 5-year dividend growth rate of 9.2%, and 12 years of dividend growth. Don't be mistaken with this 12 years of dividend growth because they had a flat dividend for 2 or 3 years in a row, but they have, I believe, multi-decade dividend growth if you zoom out. So look, actually, I think it's a very solid company that can withstand some setbacks. But again, I've run it through the screener now. I would really like to see their balance sheet a little bit because what I would want to see from such a company is cyclical, that it has a really, really lots of equity and relatively little debt. So maybe like a debt equity ratio below 40 or something like that, because then I know that if they want to sustain the dividend and want to borrow a little bit during an economic downturn, that I sleep still well at night.
Yeah.
So
Yeah, the issue I have with these types of companies are we talk about competitive advantage sometimes,
this commodity advantage.
but these appliances are easy to replicate, easy to make cheaper. I don't know how it's sustainable long term. I don't understand it. I'm looking at their brands between North America, Europe. I know the European brands like Hotpoint, for example, but each one of these you can make it a fraction of the cost. And I look at the appliances I have in my house, and they are competitors of these that are a fraction of the cost. I can't justify spending premium prices for something that's going to do the same thing, in my opinion. So
True.
they wouldn't appeal to me for that reason. Cohen has asked us, what's your favorite irregular dividend paying stock?
BHP, the mining company, because there's a certain floor in the dividend, and I really, really like that one. But I know what he means with the irregular dividend stock. It's those companies that pay out of earnings probably more, and therefore once in a while they might have a dividend cut. But when I think about very irregular and volatile dividends, it's BHP.
Yeah, we had a show with the Decline of Capitalist on this. My mind has gone fuzzy blank, so I can't think of who we mentioned on that. So we're going to stick with your answer for now. Jory has asked us, do you own or follow some small to mid-cap European stocks that you expect to grow a lot in the future?
Well, one is Defama. That's the biggest one. Then I have Ambra from Poland. So Defama is a real estate stock in Germany. Ambra is effectively they're selling drinks and liquors in Poland, and I think also 1 or 2 other countries. Those are the two. Can we call? Yeah, no, the rest is already mid cap or large cap. I would say those are the 2 main ones.
Yeah. Okay. Yeah, I don't think I have too many on my list. It's probably all maybe large cap or above. Probably some on the UK stock exchange. I know they have some mid caps that are quite interesting, but none pretty much on my watch list at the moment.
Okay. Hey, this made it to the end of the show, Derek. You're still alive. You didn't fall asleep. So I guess this topic keeps you awake. That's
Yeah.
really good to say. And thanks once again for sponsoring Diageo. The investors need it. It's really admirable.
Look, I did my best. I do apologize for the energy today. It's not my usual. It was a long day today. I had to get up early and drive 6 hours to stand 2 hours in the freezing cold to watch my son play football, and then make it back for this. So it's been a long day. So I've struggled through this, but thank you for most of the prep and most of the talking today. It was much needed, and we'll be back next week. I think we're looking at bonds. You've asked that question in the show, so it'll be interesting to hear what our audience thinks of that.
Yes,
so
exactly.
and we will see you all hopefully next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.